In this week's update, US markets spooked on CPI and bond yields. Aussie mining stocks far better than just about everything else, and where you can find them. And gold stocks, maybe this time. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Let's start with the usual market perspective. We've really got quite an unpredictable landscape for commodity supply and demand. There are a number of opposing forces, and it'll be very interesting to see how they play out. As examples, we've got the sanctions against Russia that are causing many commodity prices to rise very significantly. And it really has been an amazing education for me in just how many commodities that Russia and Ukraine are the major world exporters of. It really is quite breathtaking. So we've got upward pressure on commodity prices due to the sanctions, but we've also got the possibility now that China could enter a recession. Now, I don't know whether that'll happen or not, but it's, it is some sort of possibility because, COVID is really causing a problem there, and their financial system is not as stable as it really should be. So that is one supply and demand contradiction. Then we've also got inflation, which is very real now, versus what central banks are going to do about it. And again, if central banks get too aggressive, they could cause a recession, and that obviously can impact on commodity prices. And then thirdly, I'd put in there the absolute zeal that has taken hold worldwide to achieve a clean economy versus the normal economic destruction of demand that you get when you get extreme prices. And we've now got, particularly in the lithium area, we've got prices that are just off the map. And at the moment, car makers are just having to pay it. But there'll be a point where other alternatives will be sought. So we've got this situation between the need for a cleaner economy and prices that really are just getting out of hand. So that's another interesting dilemma in the commodity space. And no one can really say with confidence how these balances are going to play out. But look, I'm going to have a stab at it. I feel confident that the clean economy is going to win out. I just think the whole world is now too committed to this process. And I think it's going to be a matter of the economics are not going to get in the way. I think people are just going to have to pay what has to be paid to get, to get electrification and decarbonisation happening faster than what it is at the moment. The other thing that I think will happen is that central banks who've spent the last decade and a bit doing everything they can to hold economies up, I don't think are going to embark now and throw all that decade's work away and embark on some sort of incredibly aggressive process like we saw Paul Volcker do in the late 1970s, 80s, to crush inflation. I just can't see them doing that. So I think inflation is going to be able to allowed to run hotter than would be normal and which most people would be comfortable with. And so for all those reasons, I think commodity prices are going to stay high. That's the bottom line. So we've got all these tussles at the moment in the financial markets. We've got the 10-year, 2-year spread has inverted a couple of weeks ago, and then it's just as quickly it's gone back the other way. And now we're significantly positive. In fact, the most positive spread between the short and the medium term on the bond curves than we've seen in quite some time. So looks like it's just another false signal, which I think the last one was in 2019 when the curve inverted for about a week. But I would note that the real yield curve, so that's nominal inflation, nominal yield versus inflation, so the real yield curve is negative, I beg your pardon, is positive and hasn't inverted yet. So if you're looking at real yields, the US economy is mostly pointing to solid economic growth. Now, there are some numbers that you can point at that starting to look a bit questionable, but if you take all things into account, the US economy really is still looking like it's on a fairly solid economic growth path. So unless the Fed really does something severe and significant, I just can't see that a US recession is likely in the next 12 months. But China could see a recession. You know, I don't think that's out of the question. And China is more likely to go into a recession, I think, than the US. So the likely outcome in America, for me, is that we don't see a recession in the next 1 to 2 years. I think that's the most likely outcome. And if that's the case, then we're going to get the normal situation that happens, and that is during the early stages of economic growth, we get interest rates rising, but equity markets don't peak in that cycle for 18 months or so after interest rate rises start going up. Now, that started last year, so we're getting towards a year into the rising interest rates. So there's probably another 12 to 18 months based on history of the stock indices continuing to make some significant gains. And those gains typically average somewhere between 15 and 25%. So continuing on with the likely outcomes in America, we're going to see very, very significant divergence between various industry groups and stocks within those groups. And it's going to be quite substantial. I think at some stage growth stocks are going to make a comeback, but at the moment it's very much about energy and materials, and to a degree healthcare in particular. The likely outcome in Australia, I think we're also going to see very, very large divergences here, and we are seeing that already. But it's going to be mining and energy, and they've really been carrying the can for the last few months, really, and they've significantly outperformed the rest of the ASX 200. Volatility is going to be high because inevitably, when the market gets fixated on certain parts of the market, they just get overheated, and then we reach a point where there has to be a significant adjustment. And I'll show you a couple of charts in Australia just to validate that. So that's the overall perspective. I think there's still very, very good money to be made, but it's going to be a very volatile environment. You're really going to have to be on your toes. Just owning a diversified portfolio and not paying too much attention to it is just not going to be even close to good enough. And I keep banging on about this all week, but a clear plan is required, and it's not a hard thing to do, but it's something that the vast majority of people seem to resist. I don't know why. American stocks fell 2.1% for the week. Yield inversion disappeared, but the ratio spread charts really have turned very poor again. We had a couple of weeks where they got better. It looked like money was flowing back into growth stocks, but all that's been stopped in its tracks. The yield has now surged, as we'll see, and that's put a stop to it, and the money started flowing back into defensive areas. The US dollar index has now cracked the 100 mark, so we're back above 100. The yield surged to 2.83 on the 10-year. The VIX finished, I think earlier in the week, it got up to 25, finished just under 23. And that yield spread between the 10-year and the 2-year is now back up to 0.36. So these are some significant moves in those particular markets. So if we look at the 10-year 2, you can see we had a tiny little inversion in August of 2019. The spread got to its widest point around 1.6% in April of last year, and then it inverted very briefly, but look at how quickly that's come back. So that's the 10-year really advancing, and the 2-year not doing very much. If we look at the actual 10-year itself, let's have a look over the last 3 months. You can see we had a little consolidation there from January through to March, but from the end of March, for the last 30 days, it's been up quite steeply from around 1.7, and now we're above 2.8. So that's a very steep trajectory on the 10-year, and that's why we've had this reversal back into defensive stocks. That growth stocks have just been shunned, and particularly technology stocks. And there's the VIX index. So let's take a look at some of the key charts. So this is the S&P. It's not an index that I place a lot of stock on. I think you've got to look under the hood these days, because the S&P is giving you the combination of aggressive and defensive, and to a degree they're cancelling each other out. So the S&P looks fairly mild. But we are now back below the 200-day moving average, so that's not positive from a technical perspective. But it's really when you start to look at where the money's flowing that you get a sense of the sentiment in the market. So this is the small cap growth stocks, the ratio between growth and value. And when the line is dropping, it means that the growth stocks are underperforming. The value stocks are doing better. Money flows into defensives. Now, it's far more in balance than when you look at some of the bigger sectors of the market, but nevertheless, it still is trending down. So this is the 1,000 growth versus value. Unquestionably, after this quite significant bounce that we got, we're sliding away again very quickly, and you'd have to say that there's a more than even money chance that we're going to break these lows, and as money continues to flow out of growth into defensive. This is consumer discretionary versus consumer staples. So again, it's just telling you where the sentiment of the market is. The market is going preferentially into the staples, defensive stocks, and they're not in consumer discretionary. And this is, we won't worry about that one just yet. I'll come back to that, and that one in as well. In fact, I must have missed one on the way through. This is the one that I missed. This is the NASDAQ, which is more growth orientated than the S&P. And again, you can see we had a minor breakdown, significant rally from the middle of March for a couple of weeks, about 3 weeks, and then it all has just fallen apart again. And whilst it wasn't a massive move on Thursday night, it still looks pretty negative. So that's the reality of the outlook for the US market. Money is hiding. Now this is the bond market. This is TLT, which is a 20-year Treasury bond ETF. So this is a basket of longer dated bonds in an ETF, and you can see it's falling away very quickly. So that means that bonds are being sold. Bonds being sold means yields are going up, which is, of course, is what we're seeing. So you would expect that is what that chart would look like. Turning now to the US dollar, so you can see we've now breached 100, and the last time we breached 100 was back here as we headed up into the end of 2019, just before the COVID crash, and then everything fell apart. So that's the US dollar. The Aussie dollar has been holding up a lot better than you would think, just a simple opposite direction, inverse direction to the US dollar. So this is commodity prices, of course, that have held our dollar up a lot better than otherwise would be the case, and we closed it at 73.54. So let's just have a quick look at the numbers for the Aussie market. So 73.54 is where we finished. Our index ended up 0.6 across the week. So at the index level, we outperformed, but it's really resources and small caps that are leading the way. And within the resources and small caps, there was some extremely significant gains in a number of commodity areas. This is not just an electric vehicle situation where the battery material stocks are doing well. There are other there are other really good areas of the market as well, and a few outside of mining also. Okay, so turning now to the Aussie ASX 200, you can see quite a nice finish on Thursday, and we're basically back only a whisker off all-time highs at the index level. But it's thanks to materials, which are pretty much setting a new all-time high. It's thanks to energy, which is really percolating with oil above $100. So it's gone up quite steeply of late. The banks not doing too badly. They're not that far off their all-time highs. Healthcare, though, is certainly struggling. Utilities have done well in Australia. Let me just find utilities. There we go. So utilities have done quite well also. And just a couple of other charts to look at that are important. This is XEC. This is the Emerging Companies Index in Australia. And you can see the red 200-day moving average line is moving up very steeply and quite smoothly. And the price has been able to sustain itself above there. All the shorter term moving averages are pointing up. So the Emerging Companies Index, we've got a lot of terrific companies in the mining space and the agricultural space that have got just a fantastic outlook. And some of them are expensive, but some of them have not really been picked up by the market yet. So there's still terrific opportunities in this area. Now, I mentioned earlier that we are going to see very significant volatility amongst these stocks. So terrific outlooks. I think you can make multiple times your money over the next couple of years in a lot of these stocks if you select them well. But what's going to come with that is a lot of volatility. And here's one of my favourite stocks, Novonix. We first entered this stock under $1. It went all the way to $12. An incredible run. And then it just really got ahead of itself. It should never have been at $12. And so it pulled back and found support at $5. And now we are forming higher highs and higher lows. Now, this is not a recommendation. It's just an example of the sort of volatility that you're going to have to deal with. If you want exposure to these sort of returns, these big multi-bagger returns, then you're going to have a game plan really well sorted out, because it's pretty difficult to see a stock that you own fall from $12 to $5 and not feel the urge to do something about it. And generally when you feel the urge to do something about it, it's generally at the worst possible time. So hence the need for clarity. You can make excellent returns in this market, but you've just got to be on the top of your game. You really do. Now, turning to gold, so precious metals. Gold is definitely looking better, and we closed at 1975 after forming a slightly higher high during the week. I think we got up to 1982 during the week, but as you'll see from the weekly chart, we did have a surge a little while ago in early March. That fell back. That was really at the start of the Ukraine war. But we didn't fall very far. And we only came back to where you would expect to find a bit of support. And we've bounced from there. And now we're starting to exceed the previous closing highs. So gold is definitely looking better. Now, I guess I'm a bit gun-shy on gold and have been for some time, because it's disappointed us just so many times since we saw this peak in August 2020. But just it's really starting to look a lot better now. Silver not really following yet. I'm a bit surprised by silver, but it's when we get to if we look at GDXJ, so we look at the gold miners. So the gold miners have now broken out. No question, they're looking a lot better. And I'm always encouraged by the gold miners outperforming gold, because that's generally a healthy precious metals market when the gold miners are moving ahead of the underlying metal. This is the Now the spread chart that I'm looking for is this one. So this is GDX versus GLD. So GDX being the ETF covering gold stocks, and GLD being the ETF that covers the gold price itself. And again, this is a ratio. So the line rising means that GDX is outperforming, doing better. It's rising faster than what GLD is, and that's healthy for that market. And you can see since the lows in this ratio, which occurred at the end of January, it has really been a very, very sharp move. So gold stocks would appear to be coming back into vogue. So just to summarise there, up $26 to 1974. And I also would note from a fundamental point of view that exchange-traded products for gold are now back to all-time highs in terms of assets held. So that's not a price. That is the assets held within those ETPs. So that means that serious money has been flowing back into this area. And GDXJ, miners confirming the move. But as I've been saying for a number of weeks, I'm playing it safe and not buying gold stocks like established producers that are really only going to go up if the gold price goes up. Because I'm just gun shy on gold, and I don't want to be reliant for my gold stocks to do well. I don't want to be reliant on the gold price going up. It might, but I don't want that to be the case. So have been focused for some time on gold stocks that are a strong emerging story. They've made a significant discovery, a global, world-class discovery, and as that project progresses and gets de-risked, then the value of that stock is going to go up, even if the gold price doesn't. I just think that's the prudent way to play it at the moment. Other commodities, copper was steady at 4.67. Nickel eased back a little bit, but it's still extremely buoyant. That's a very, very profitable price for nickel miners. So we've seen a reduction in the volatility. We really did get quite extreme there for a little bit in nickel, but that seems to have settled down now. And the long-term supply-demand situation across these base metals continues to be very favourable, despite the fact that we could end up in recessions if central banks just go too hard. And of course, also we've got supply chain issues that are perhaps leading towards economic recessions as well, and that is not necessarily good for commodity prices. But I think the push to decarbonisation and all the infrastructure that goes with that, and the electric vehicles that go with that, I think are going to continue to hold up commodity prices pretty well, even in the face of recessions. Now, crude oil was back, got down to about 97, but we've bounced back hard now. We're back at 106.5. And of course, when you're thinking about energy, really don't lose sight of uranium in that energy mix. And uranium is certainly one of the very few sectors in America that's done really quite well in recent months. There's the spot copper chart. Not a lot happening there in recent weeks, and the same with nickel, that extreme volatility settling down now. So wrapping it all up, the vital things that you need, and you've heard this from me before, is that you need an open mind to sudden shifts in the market. A couple of months ago, we were in full bore correction, and then for no apparent reason, that just turned on a dime and went up for 3 weeks. Money flowed back into growth stocks, the indices went up, and there appeared to have been a very sudden and significant shift. Well, that lasted 3 weeks, and now it's gone back the other way again. And unless you are prepared to have an open mind and be reactive to those situations, then you're really going to struggle. If you're someone that needs to be right, and you take a position and you're going to stick to it come hell or high water, then you're going to lose a fair bit of money in this sort of market. You've just got to be open-minded and acknowledge what the market is telling you. You need a plan that suits who you are, and that's just such an individual thing. There is no one size fits all. But it's something that you can work your way through, and certainly in portfolio analyst, you've got the opportunity to do that in various ways. A portfolio analyst last week, we covered how the direction of the US market is impacting local mining stocks, and the answer is quite loudly was not really very much. Local mining stocks are just doing very well, thank you very much, and it doesn't really seem to matter what the US is doing. And there were a number of high conviction examples of mine in lithium, potash and copper. So if you're looking for some additional input, if you're looking for, I think, valuable perspective, then certainly Portfolio Analyst provides that in spades. And we've just been, most weeks I cover my highest conviction mining stocks, and there really are a great many of them. It's really an embarrassment of riches at the moment in that sector. So that's it for this week. There's my email address, website address, has got more information, and I think it'll be a short week, obviously, but one that I think will hold plenty of fascination for how things are unfolding. So I'll be back with you next Sunday. Cheers.